It seems like everyone is buying gold right now. Has the financial world finally come to its senses again? After the crypto and NFT bubbles, is it not time to reflect and start investing into something real again? Something you can actually touch and store at home at arm's reach. As one of humanity's oldest asset classes, gold inspires a timeless sense of safety and security. And just like Shakira's hips, numbers don't lie. Here is the shocking truth. Since 1975, gold has delivered an average return of just 1.2% per annum, while stocks delivered 6.8. And gold's maximum drawdown was a staggering 83%. I'm about to show you why gold is not the safe haven you have been told, and why I say gold is mold. The source for my claims is from a book from Gerd Kommer, Souverän Investieren, and the full title translates into English to something around confident investing with index funds and ETFs. It is the best scientific book on passive investing for multiple years now in Germany, and Kommer is one of the most influential and respected personalities in the scientific investing community in Germany as well. There are valid criticisms against Kommer, which I also hold, and I don't necessarily agree with everything he says or writes, but some of the disagreements and criticisms you could have against him would be a topic for another video. And this also doesn't diminish most of the credible and well-researched and articulated information he provides in general and also in his book. Yeah, and also this is the nice part about the scientific community that, it's not necessary to agree with everyone on everything, even if you like the personality. So to get specific, the information I provide here is from his sixth edition, published in 2025, which also then means that the information and the data he gives there is up to date. And context, where exactly from this book do I draw this from? It's from his chapter 5.1. Asset classes you don't necessarily need, but you can think about. And first, he has a table where he compares the returns and risks of gold and stocks in US dollars, real returns. And these numbers are before taxes and costs. And the volatility is provided as an annualized standard deviation of monthly returns. The data he uses in the table is from the Gold Council, MSCI, and Dimensional Fund Advisor, but he doesn't get more specific, like where exactly he draws which numbers from. But I think it would have been, then this chapter would have been even larger and this book even bigger. So what do we have from 1975 to the 6th of 2023? So nearly 50 years. Gold, as I said in the introduction, only had a return of 1.2%, and stocks nearly 7% with 6.8%. And now we come to one of the reasons why it feels like maybe now gold is in the hype again and everyone wants to buy gold. Because from 2007 and to the 6th of 2003, so 16.5 years, nearly 17 years, gold had the same per annum return as stocks, so 4.3. And for volatility, gold has 19%, and stocks only 15%. We already know stocks are one of the most volatile asset classes we can invest in, and even though you have this impression of gold of being like the really secure haven investment, it is quite interesting to see that gold has 4% higher volatility than stocks already. And then also for the maximum drawdown for stocks during the time frame was 54%, but gold had a staggering 83% of maximum drawdown. And then also, if we look at the Sharpe ratio values he provides, is stock with 0.04, gold 0.04, and stocks 0.14. So compared to stocks, gold just seems worse in all regards. Besides, of course, these 16.5 years where it had the same return as stocks, but even then, it doesn't look so good if we include the longer time frame. Um, and then you might ask, well, gold is around for like so many decades and centuries now. Why do you only start at 1975? Maybe for some reason, Kommer has a grudge against gold, and that's why he's just cherry picking a time frame that suits his argument. And yeah, this is why gold looks so bad in the comparison to stocks. But he actually explains why he chooses this time frame from 1975. Because in September 1971, the US, I mean, is still the largest economy in the world, but also at that time, also the US was the largest economy at the world. They abolished the gold standard. And yeah, the system they had there in the US was the Bretton Woods system. And he also explains that in a currency with a proper gold standard, that the real returns of gold compared to the currency must be zero or negative, which was also the case. And additionally, there was not just that they abolished the gold standard, but also later on there was an additional uh, private households were forbidden to buy gold as an investment. And they ended this, so the gold ban for private households, ended it only at the 31st, 12th, 1974, so some years later. And also these gold bans for private households to invest, they, at least to Kommer, he says that they existed in every other large Western or Eastern country. And many of these gold bans stayed longer in place than 1974. But yeah, with these both facts combined, he thinks that at the beginning of 1975, that the gold price only then really reflected the supply and demand. Then also additional questions like what even is the true price of gold? So like in comparison to stocks, bonds, or real estate, gold doesn't have a cash flow similar to other resources. And therefore we can't really calculate fundamental present value. And also in comparison to other resources, gold has no major industrial usage. So in short, if everyone wakes up tomorrow and decides, well, they don't care about gold anymore, then it wouldn't be worth anything anymore. You can make this case like for many resources, but even then, if everybody decides to act crazy, you still have many industrial applications for other resources, but this is not necessarily the case for gold. Um, and also, like considering the long history and value that humanity has placed on gold so far, I don't think it's very likely that suddenly everyone will wake up and decide they don't care about gold anymore. But yeah, still, I think it's something that can explain to us why we see in the long term so much lower returns on gold. Because if we invest in a company in stocks, then we actually invest in this business that is like driving and innovating and producing products, while gold is just sitting there and not really doing anything. Then also, of course, the gold in question, I'm sure everyone would love to know if we can predict gold prices. But of course, like it with gold prices, it is similar to the stock market, that the gold market is just very efficient, too efficient for us to be able to predict gold prices. And if you are interested yeah, to learn more about like efficient markets and what that means for stocks, yeah, I encourage you to like watch one of my first videos I did on the topic. Um, and then also he says that gold is a bad hedge against short and also medium term inflation, but probably useful during hyperinflation. And then something maybe like especially with recent developments that maybe many people care more about, and it's maybe also one of the reasons why people consider buying gold is to prepare for a catastrophic event. And probably you have this image of, you have some little gold bars at home, and if shit starts to hit the fan, at least you can take your gold bars and try to leave the country or something like that. But yeah, is gold actually useful during catastrophic events or maybe during the next depression? There's no scientific consensus, and he quotes Bauer 2010, Bulut 2019, and Gomez Porqueras 2020. That yeah, they didn't come to one conclusion. But of course, one of the two most impactful catastrophic events we had in recent history are, of course, World War One and World War Two. And unfortunately, gold prices in US dollars fell during both of the world wars, which to me was also quite a yeah, surprising fact. I always thought gold, this beacon of safety as an investment, but apparently it's not. And then also for you, if you think of buying gold to prepare for one of these possible catastrophic events, you gotta really ask yourself the question, well, of course, the fear is very human and it's very understandable. And especially with recent developments, you and me might make the case that catastrophic events like this don't seem that unlikely anymore. But still, even then, is it really such a big probability that you should seriously consider preparing for that? And if you want to prepare financially for one of these events, would it be really that useful for these horror scenarios you want to prepare for? And then also, another really important question is, well, does gold improve the performance of your portfolio? And the answer to that question should be pretty logically. If we think back of the long time frame where gold has a really low return compared to stocks, probably not. And especially if we consider the full time period since 1975. But I think here maybe is gold's silver lining. Gold mixed into a stock portfolio reduces risk a little. Think of volatility and maximum drawdown, because gold and stocks have a correlation of nearly zero. So it sounds like adding gold in the name of diversification could make a lot of sense then. But of course, this recommendation could also always change. Just recently, this year, I saw someone like posted a new paper about this topic where they think that there's nearly zero correlation between stocks and then the S&P 500, that they think that they now correlate more strongly with each other. But still, at least historically speaking, and from the advice from Gerd Kommer, normally it was like this. But of course, if this is one of the reasons you want to invest a lot into gold because of this nearly zero correlation, it makes sense to keep up with that. Yeah, and if you now like all the information I now provided about gold is more like, I think most private investors probably shouldn't think or shouldn't be that excited about more gold. But if you do, you can also consider buying gold ETCs instead of just buying real gold. And the advantages for that would be that it's cheaper, easier, and the risk of theft and loss should be lower if you compare that to holding gold at home. Of course, for the aspects of cheaper and easier, that might depend where exactly in which country you are and which city. And of course, I saw for Americans that you can buy like the little gold bars easily accessible in Costco. So maybe that's not really something um, that is an advantage for you for gold ECTS. But even then, even if you try a lot to, reduce the risk of theft in your home, I think most private investors, you won't be millionaires or billionaires and have like top-notch security. And even then, like if someone really, for whatever reason, wants to break into your house and is convinced that you have valuables they really want to have, then it can be like you can try to make your house, less friendly um, to thieves. And you can also, try and do research. Okay, how do I like buy a vault and store my gold there? Even then, if someone really wants to break in a band of like thieves and professionals, they will probably achieve that. They will probably do that. So yeah, for just the safety reason, I think yeah, gold ECTS, if you want to invest in gold, yeah, should be a strong consideration. Of course, gold ECTS are not perfectly safe. There are things that can go wrong there. You can be hacked, or there can be some problem, with your broker or whatever. But I think these risks are probably much lower than you are of, a theft happening in your house. Yeah, and then of course, on the other hand, if for you the reason is to buy gold, that you want to be prepared for the worst case scenario, for whatever reason, like there's a big, you have to leave the country as fast as possible, just the shit hits the fan and you want to pack your seven things and just go, then of course, if you have your gold, like your money invested in a gold ECTS, that might not be possible. While if you just store your little gold bars in your wallet, then of course that's something you can do. But yeah, for this scenario, like it feels good, it sounds good, but is it really that likely to happen that you are in a situation where you have to leave the country for whatever reason, and you also want to bring some of your little gold bars because otherwise your, I don't know, US dollar currency and Europe all fail at the same time and you can't pay with cash anymore, you can only pay like with your little gold bars. Ah, I don't think it's that likely. But of course, if that is a worst case scenario you want to prepare for, like you could consider storing some gold at home for this reason, while also keeping in mind the higher risk of theft. So, in conclusion, yeah, Kommer concludes that private investors don't necessarily need gold in their portfolios. But it is a consideration for households that deem a catastrophic event likely in the next few years, or that expect hyperinflation in their currency for more than the next 3 years in the foreseeable future. And then also my own comment is, well, considering at least historically the very low correlation with stocks, um, maybe households should consider buying gold if they put a very big emphasis on diversification. And even then, that's again Commerce opinion, gold should be considered under the risky part of the portfolio. I think this is also really important. I think many people would suspect gold to be a safe investment and count it towards the safe bucket of your portfolio. But yeah, looking at the numbers and the fundamentals, yeah, it is not. So really important, gold under the risky part of your portfolio and should definitely not make up more than 10% of the portfolio. At least this is the recommendation of Kommer. And as far as I can tell, this is just his professional advice or opinion. At least like he provides, the sources where he takes his numbers from, but for this 10% number, he doesn't cite anything particular why exactly this 10%. Yeah, I think it's probably, a hunch. Yeah, but a good number to go by, I suppose. And with that, I want to end this video with a small rhyme. So if you have like in summary, um, private investors, gold's optional C, unless hyperinflation or disaster may be. Keep it small, never more than 10. A risky asset, not a steady friend. It feels so safe, or you're told, till drawdowns bite and profits fold. Gold is shiny, yes, but behold, numbers whisper, gold is mold.